Hi, everybody. I'm Bob Marone from Westchester Talk Radio. We're here today with Peter Lang, Managing Director and Partner at Hightower, Westchester. Today's topic, qualified charitable contributions, also known as QCDs. Peter, can you tell us what a QCD is? But before we do that, how have you been?
I've been great, Bob. Thanks for asking. You look wonderful on video, by the way, today, Bob.
Well, so do you, Peter. Our mutual admiration society continues. So QCDs, what are we talking about?
So let's start with what a QCD is, or a qualified charitable distribution. It's relative to a person's IRA accounts, and if you are over 70 years of age is when a QCD applies. So if you're under 70, this doesn't really necessarily apply to you, but it's something you can certainly think about for your future. We're very used to our clients, either writing a check to support their favorite charity or even donating appreciated stock to their favorite charity, which also has certain tax benefits, which we're not going to talk about today. In this case, again, we're going to just focus on one small topic of using your IRA to give charitable contributions. So let's level set this and say, let's start with somebody who is 72 years of age and is starting to take a required minimum distribution, right? At age 72, everybody must begin taking required minimum distributions from their IRA accounts. There's a very simple formula. It's based upon the client's age and the value of the account as of December 31st in the prior year. So let me give you a simple example so we can put some dollars and cents and make this conversation a little bit easier. Let's say we have a 75-year-old individual and they have an IRA account that's worth $250,000. Based upon those two simple facts, we know that the amount of required minimum distribution they must take will be $10,917 this year. So if they take that, and let's assume they're in the 25% tax bracket, on that $10,000 and change, they will pay about $2,700 in federal taxes.
Okay, so far that makes sense. So how does a QCD factor in?
Great. So now that we have the basics of an RMD, let's talk a little bit more about the QCD. First off, the law is anybody over age 70, and we'll talk about that discrepancy in a couple of minutes about the ages. And under the law, an individual can donate up to $100,000 per year from their IRA accounts to any qualified charity that they choose. So let's say in the example I gave just a second ago, you forgo the $10,917 and you give all of that to your favorite charity, whichever charity that is. You don't get a tax deduction on your taxes, but you also don't pay the $2,700 in federal taxes. So you have that savings in taxes. In addition, you don't have to take that additional income. And the key part is that $10,917 that you gave to your favorite charity, that satisfies your required minimum distribution. And again, if you wanted to donate more than that $10,917, if you wanted to donate $20,000 or up to $100,000, you can do that. It's okay to exceed your required minimum distribution, either for your own benefit or in this case, for the benefit of a charity. And again, let me get back to that little quirk. Remember I said the required minimum distributions are 72 and the QCD is at age 70. A couple of years ago when Congress rewrote some of the retirement legislation, they either on purpose or mistake did not change the QCD age to match the required minimum distribution. So they left it at age 70. So it is a little benefit if you really want to look at some tax planning. You can even start even earlier using your IRAs to help charities.
So that's it. Is it really that simple, Peter?
It really is. Sometimes things are as simple as they seem. The only extra step is that most custodians are probably going to require an extra form to be signed to make this QCD happen. That's about it.
Wow. Any other ideas around this topic?
Yeah, let me give you, two quick ideas around this topic, and let's just talk about it. So let's say you've got, some people have these old small IRA accounts that they might have opened 10, 20, 30 years ago, and they're sitting in a bank, and maybe it's got 10 or 20 or $30,000 in them. And they have to remember to take their required minimum distributions every year, which, might amount to $1,000, give or take, every year. And they really don't necessarily need the money. So one quick idea is, if you have that small IRA, let's say it's $25,000, you could give the whole thing in 1 year to your favorite charity or charities to support it. And you get rid of having to deal with that little bit of a nuisance requirement and distribution every year. And you've done a really wonderful thing, by helping a charity, giving them amount of money you probably wouldn't have considered doing before, because this way feels a little less painful, so to speak. On the flip side, let's say you're a higher net worth individual, and let's say you've got an IRA that's worth $250,000, and that $10,000 or $11,000 a year of income really doesn't make a difference in your life. Maybe what you consider doing is making a large donation paid over a few years to your favorite charity. Let's assume you make a $250,000 pledge, again, to your favorite charity, and you spread the payments out over a 5-year time period. So every year you're giving them $50,000 out of that IRA account. And then maybe in the last year, there's a little something extra. Maybe the IRA has continued to appreciate, and the last year's gift is maybe just something a little larger, or maybe you just take that last little bit that's left in year 5 for your own as a little bonus for yourself.
Those are some great ideas, and can really be impactful for those organizations that do so much for the community. Thank you so much once again, Peter Lang, for another great lesson.
Thanks, Bob.
Good to see you.
Hightower Westchester is a group of investment professionals registered with Hightower Securities LLC, member FINRA and SIPC, and with Hightower Advisors LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities LLC. Advisory services are offered through Hightower Advisors LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. Hightower Westchester and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of Hightower Westchester and do not represent those of Hightower Advisors LLC or any of its affiliates. Hightower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.